Hey everyone, welcome to another episode of Capitalise. Today we're gonna have a very interesting conversation around where should the Indian investor be investing? In mutual funds, in portfolio management services, what kind of investing style should they adopt and how? And for that, today we have very prominent leaders from the Phillipcapital team. We have Sagar, who heads the mutual fund industry and the mutual fund space from Phillipcapital, and then we have Nishit, who's taking care of the PMS. We'll allow these folks to introduce themselves and then we'll take it forward from here. Sagar,
Hi.
can you please?
Hi, my name is Sagar Mehta. I've been with Phillipcapital for the last 4 years now. So I manage the mutual fund divisions, advisory, as well as the normal distribution channel for mutual funds. We have been a relatively new player in this space, but we have managed to capture a good amount of share in the market right now.
Got it. And Nishit.
Yeah, hi Vedant. Yeah, so my name is Nishit Shah. I head the PMS and PMS desk at Phillipcapital. I'm also the fund manager and the principal officer. I've been with Phillipcapital now for close to around 10 years. In fact, next month I would be completing 10 years in Phillipcapital. Total experience I've got around 17, 18 years in this industry. Yeah, and we are managing close to around 1,000 crores plus as of now in the PMS.
That's so good. Thanks for introducing yourselves, guys. So today's conversation would mostly revolve around mutual fund space, which you are an expert of, and the PMS space, which you are an expert of. And we'll try and help the audience understand really well, like how should their investing career progress over the years, and how can they position themselves well. So for that, the markets haven't been doing very well since the last 2 years. And what do you think has changed in the last 2 years? Both of you, you can give your takes.
Yeah, so what happened since maybe since the post-pandemic age was that we had 3 very good years in terms of there was just a one-way movement as far as the mutual fund industry is concerned. So we actually came out of a very good phase where there was an upward movement where people actually saw a lot of their incomes actually double during the period. What happened was that there was, as a lot of people made money in India, started looking for better avenues overseas.
Right.
And they got a rally in some like recent rally into metals or something of that nature, and they kind of diversified themselves as they went along. We lost a good share in terms of that. Plus, the best part about the mutual fund industry as a whole that we did not lose the inflow which was coming in. It has been becoming stronger as the market kind of fluctuates a little bit volatile.
Yeah.
So I feel that this is a temporary phase, but unfortunately for all of us that we have seen the good times and now we are going to be seeing the bad times. So it's going to be a little bit of a mix in that sense. But I think the persistence generally pays off.
Got it. What's your take, Nishit?
Of course, last 15, 18 months has been a little bit of a grind in the market. If you go to see at the Nifty level, we are almost at the same level since last 18 months. I think there are a couple of big reasons. I think one, valuation wise, if you go to see, India was trading at around 28, 29 times 2 years back.
Yep.
Yeah. So a lot of money flow to other markets wherein the valuations at much cheaper levels. Suppose China was available at 11 times, 12 times, maybe Korea, even European markets were available at a very reasonable kind of a valuation. So a lot of money flew out of India into this geography.
Correct.
Second, a lot of money went into AI trade, which unfortunately India as of now we don't have any investment opportunity as far as AI is concerned, especially in the listed space.
Got it.
So a lot of money went there. Yeah. But looking right now, I think that both the situations have kind of came back to normal. I think now we are at around 21, 22 times.
Yep.
In AI trade, I would not say it's a bubble, but it seems that it's heating up. Yeah? So maybe money might come back to India and we'll see good times ahead. Yeah?
Got it. When you say AI trade, a lot of that has been happening. Can you enlighten the viewers what exactly is it all about?
So see, of course, globally, what is happening on the artificial intelligence side, yeah. So a lot of new companies are coming up. In fact, even companies in US, yeah, stocks like Nvidia or maybe the Googles of the world, Microsoft of the world. Maybe China is also so much ahead in AI, yeah. Kind of course, we saw the in between the DeepSeek revolution that had happened out there as well. So yeah, that is what basically the AI trade is happening.
Yeah.
Even when you dissect US markets as well, yeah. So it's the Mag 7. In fact, actually, it's not the Mag 7, it's the Mag 4, which has done very well in the last 15, 18 months. Yeah? And I think that has led to a lot of returns. Yeah? India, of course, as I mentioned, we don't have any trade out that side. Yeah?
Yeah.
So Yeah, so a lot of, see, it's a new kind of revolution technology,
Yeah.
and that is what the future is going to be.
Yeah.
So a lot of money is going to that side. India has always been more about consumption, demographic dividends. Yeah. So
Yeah.
so we have been, unfortunately, that is not something that is available in India. But I think, hopefully, going ahead, we should have some return pieces here.
Got it. So the last 2 years, the headlines have been mostly things are not working out, the markets are choppy, like everything could crash, US recession is coming, so much negativity around there. But what do you guys think? Like the headlines and what's the reality?
Yeah, as I think India is a consumption-driven economy.
Yeah.
A lot of it depends on how much we consume, and we are, till a certain extent, we are an agrarian economy as well. So we have a high domestic production, and then most of the consumption goes inwards as well. So we are in a state of flux because technically we have become self-sufficient in certain ways. We may not be dependent too much on the overall global market when it comes to certain things, but yes, energy needs are getting still imported. We are still in a process of what we call, we are in a transition economy phase, where we are on the phase to becoming a developed economy, and since we have a large population, the process is relatively slow. So if I have to consider, and unfortunately for us, that we are usually laggards when most technologies come in.
Yeah.
We were the later,
For sure.
we took over the data part little later, but we managed to really make good use out of it. I think with AI also it's going to be the same thing.
Yeah.
We are going to be laggards, but I think when it does come, we're going to be a big part of it. Right. I think what is happening is, this is what the comment was, that we as people, as world leaders, have stopped listening to each other.
Yeah.
So it's created a sort of flux in the environment where a lot of people are doing unilateral stuff, and they're not able to kind of getting it into a fixed mode of doing things, which was what was earlier done when the earlier administrations were there.
Yeah.
There were certain, you knew that certain things were going to happen, and it happened. Yeah, certain things do complicate, wars complicate,
Yeah.
other issues do complicate. But I think the moment as they keep dying out, because everything has a phase, once that phase goes out, I think we'll be in a better stage as we go along.
Fair. Yeah.
Of course, coming to a specific question, of course, I think what we had seen, see, I think before COVID, we had around 4 crore demat accounts, and that number has gone up almost 4x kind of.
Yeah,
a thing.
dramatically.
So a lot of this new investors who are coming, they saw 3 very good years, 2020 to 2000 till 24 actually.
Yeah.
Last 15-18 months has been a sideways markets. In fact,
market.
if you go to see, the broader markets have corrected.
Yeah.
So I think for this new set of investors who are coming, they are finding it little bit difficult to accept. They had come with a certain kind of an expectation.
Yeah. Recency bias was also there.
So I think that is what has happened. So of course, that is where players like all of us come into picture. We also need to educate the investors that it's equity market returns are never linear in fashion.
Correct.
It's always going to be like this.
Yeah.
Your horizon matters, and of course the where you have invested, that matters most.
And to the point that you said that the broader markets have actually corrected, but it's just the Nifty levels that are appearing to be at the same levels, but mid caps, small caps have dramatically corrected.
True.
People are like really worried that my portfolio has just kept bleeding, and they've also lost to the index funds. So it's so what do you think? What's your take on that?
I think very Vedant, that's a very good point. In fact, I was just doing some number crunching yesterday on my flight back from Delhi. So I could see that close to around 53% of the companies are more than 20 to 25% down. So that's a very large number.
Large
so
number.
At index level, as you rightly mentioned, that we are flattish or maybe 5% plus, 4-5% plus. But broader markets, it's a huge correction.
Yeah, the portfolios are down.
So I think that is how markets are always going to be. So there is always going to be a dichotomy as well. So it's just that, again, investors say the benchmark is maybe 4-5% plus or flattish. I have not even made FD returns, especially this new investors who are coming. So we keep getting a lot that I was better off maybe in an FD. Of course, that recency bias of that precious metal rally that has happened in gold and silver as well, wherein they have shot up. They were saying, oh, I was better off. I would have invested into gold and silver, but they don't understand. Silver has done so well after almost 20 to 25 years. So it's not that. You can participate in everything. So at Phillipcapital, we are always believer of a multi-asset approach. It is not this or that. It is always an and. So when it comes to mutual fund and PMS, for an HNI client, I always say it is not a mutual fund or a PMS. It is a mutual fund and a PMS. And something else,
Yeah.
and so that is what I.
Makes sense. So for investors that are investing in your through you in PMS,
Yeah.
and they're panicking like my returns are like helter skelter. It's not giving me good returns. I would have been better off investing in an FD. How do you psychologically help them see it well and like sleep well essentially?
Of course, I think that two set of investors. One who have been investing for a very long period of time and they accept that this kind of an underperformance is quite possible. See, in a PMS, what happens? It's a focused portfolio. Yeah, it's not a very diversified portfolio. On an average, what 25 to 30 securities. Yeah, so during times like this, we might underperform. Yeah, so the investor who has been investing into markets since last 15, 20, 30 years, he understands.
Yeah.
That this all this underperformance will be taken care of once
Yeah.
market bounces
True.
back. The new set of investors who have come in last 2-3 years, so them, I think it's not about panicking.
Yeah.
I think they want answers.
Yeah.
That Nishit, we invested into
Right.
stock markets, into a PMS product, thinking it would have done better.
Right.
So for them, it's just we need to educate them that this
Yeah.
is how it is. A focused portfolio like this might underperform during these times,
Yeah.
but a lot of this underperformance can be taken care of when market moves back. So we need to educate them that markets returns are not linear in
Exactly,
way. The companies that we have invested into all are good quality companies. The EPS is growing. It's just
Yeah.
that market is not appreciating that right now.
Yeah.
But there will come a time. See, just let's go 2 years back. Everyone wanted to invest into mid and small caps.
Yeah.
In fact, so many of the fund houses had to stop accepting money, lump sum money
Yes.
into mutual funds,
Yeah.
small
True,
caps
true,
and mid
true.
caps. Today it's the exact opposite.
Yeah.
When it's always about greed and fear.
True.
So right now there is some bit of fear. I would not say a lot of fear,
Yeah.
but there is some bit of fear that mid and small caps are not the right way. Today everyone wants to invest into gold and silver.
Yeah.
The first question: do you guys invest into gold and silver? So that is what I think. It's the part and parcel of the entire journey.
For sure. Speaking of that, you said that companies on the underlying are actually doing fairly good.
Yeah.
It's just the numbers that are not reflecting. What parts of Indian economy do you think are doing fairly good, but in the headlines they just appear weak?
See, I think what had happened 2020 to early 2024, everything did well. Okay, I always keep on saying that gadhe ghode dono bhage.
Bhage,
In fact, the bad stocks did much better.
Yeah,
because
true.
that is where maybe the leverage was higher,
Yeah.
it was coming down, the growth rate.
And also everyone was investing in small
Yeah.
cap and mid cap
Yeah.
for the higher alpha. So
of course that the liquidity flow was there,
Yeah.
that also helped kind of thing. So everything, this market is going to be a very selective market. So maybe I think this market is going to be more like a 2016 to 2020 kind of a market, wherein selective stocks are going to do well. So there are many pockets which are going to do well. Yes, I feel BFSI as a sector is going to do very well. Especially
can you, for the audience watching, how would you explain BFSI?
So BFI is basically banking and finance industry.
Yeah.
So maybe private banks. There are certain PSU banks which have done very well. Large PSU banks. I think that is one space.
Yeah.
There are certain NBFCs. There are certain gold loan companies. So this pocket is something that we are very confident on that this would do well. Then there are of course stocks in consumption. Again, India has always been a consumption story.
economy.
So there are many opportunities. But in consumption side also we are looking more of at the premiumization. I think what is happening at the bottom is there's now too much competition coming in. So everyone is eating into everyone's
True,
share.
true,
So
true.
let's take an example of a razor.
Yeah.
Today, if 10 years, 20 years back, if I wanted to buy a razor, it was always a Gillette.
Yeah.
Today, there are so many other guys. Private
Yeah.
labels have come up.
True,
There are new startups which have come up. But look at in the premium segment. Say suppose many fancy houses have been sold today. So earlier we used to put maybe in our kitchens we used to put stainless steel sinks. Today there are quartz sinks. So premiumization. So that is on the consumption side. I think premiumization is going to play. So that is one space that we are looking at. Then there are certain capital goods and engineering companies. I think those would do well. Then I think CDMO and pharma. I think that's a very big space to look at, especially with the US Biosecure Act coming in. I think that is one side.
What act is coming that you're optimistic about?
So it's a US Biosecure Act.
Okay.
So basically what everyone wants to lessen their reliance on China. So that is where US has come up with this new law, wherein they will, each of the companies are mandated to diversify, and that is where maybe a country like India,
Could
should benefit.
Yeah. But recently the pharma industry and the stocks have like really corrected because of their tariffs and everything. You think it's just a short term, right?
I think no, pharma industry is not impacted,
Yeah.
because the tariffs are not on pharma. So
Okay.
basically, they are not on 2-3 large sectors. One, they are not on auto ancillary. Pharma is not included in this. So they are as of now.
He just called it out, but it was kind of
see,
bluff.
as of now, the sentiment is so bad because of Trump. See, the tariff that we are getting impacted is maybe 0.5% of our GDP. But it's just that the rants that keeps coming out of that side, that spoils the sentiment. So I think it is more than anything. I think that is what we need to be skeptical.
It's the sentiment in general. Sagar, what sectors do you think?
So I think we have all the sectors which are focused on the rural economy, including the ones which may come about in tourism as well. This is again a futuristic outlook in terms of how hotel industry I think will do well. We also have certain sectors in branded pharma has been doing well, which has been kind of pushing the entire pharma sector up more than the generics. As we also have, we now started slowly moving towards into sectors which kind of support transport and logistics, which kind of support. So those sectors, I believe they might do well. I think gold has been, because gold has been doing so well, the related companies to gold have been doing well. Gold loan as well as gold recovery companies. I think one sector which has not yet done very well, which I hope will do well, is the new age IT companies will come back in very strongly. Also bolstered by our own industry, which is the mutual fund industry, asset management companies or wealth management companies, which will come in strongly because they are the ones which are kind of holding on to those larger assets and not trading them across the market. So we are basically what indirectly kind of in terms of a storehouse of all those stocks and everything which are going in. The psychology which has changed in the last 2-3 years with respect to is that a lot of these diversified mutual funds and a lot of they've kind of shifted to whatever is doing well. The momentum, whatever momentum was favoring them, right? There has been a situation where people who stuck to their guts have kind of done well with a limited set of audiences, limited set of sectors as well as stocks. But those people who have kind of diversified into multiple spaces have kind of come down. So people who have invested in who started investing from 24 have had the worst brunt of the market, whereas people who started in 2021 or 2020 when the market actually fell down during the initial phase of COVID, they've kind of done well. So I have a term which I usually call them, they're children of the bull market. They're yet to see a bearish market. Most of our time growing up, we have seen a bearish market for a long period of time. We are also bolstered by the government's policies, which is a key indicator to how they will go about. Yes, we are a transition economy. It might take us some time for us to kind of get into the flow, get our levels back up. I'm not going into all the quantitative side of things, but it's more because a lot of these things are sentiment driven. And I said, people have stopped speaking to each other. The moment they start speaking and come back to where they were earlier, back to status quo, we might do well. There has been also unfortunately, we also believe in a philosophy that we are the best in terms of most investors do that. I will take my own calls. The do-it-yourself investor has kind of suffered the most because he has tried to do things beyond his purview. Let's assume, for example, I'm a person working in an engineering firm. I decide to do stocks. Technically, I'll be like, I know about these sectors. I knew my own company is going to do well. And they kind of started investing on their own. They started picking their mutual funds. They started picking their stocks. Those people are the ones who have suffered most, especially people who have come into the workforce and started investing. What happened during COVID was that this entire investment phase came about. We suddenly started becoming savers. So, one thing which I'm more little bit worried about is that India slowly started to become a little bit of a savers economy instead of being an investors economy. As when I say the second, third generation of a lot of these entrepreneurs started moving to become savers instead of actually going back into their own company. That might be a little bit of concerning point as we go ahead. But I think till now we are well poised in a certain sense.
Got it. Now we'll take it up as how would you approach as a mutual fund guy, and how would you approach as a PMS guy, all right?
Sure.
So in terms of the market volatility, how would a mutual, also let's just explain to the audience the primary differences between mutual funds and PMS also, right? So we'll start with you. PMS is something a lot of retail investors don't truly understand. So just help them quickly understand what PMS is.
Sure. So of course, PMS in many ways, of course, it's similar to a mutual fund, of course, but it's very different as well. Yeah. So both the products are for investors who do not have the time, expertise, and knowledge to invest into equity markets or maybe into markets. The product is for them. Yeah. Having said that, but the main first difference is the ticket size. Yeah. PMS, the minimum ticket size is 50 lakhs. Mutual funds you can invest as low as 500 rupees. As well. Yeah, I think that is one of the major.
Even 50 rupees now.
Of course, yeah. So that is one of the largest difference kind of thing. Yeah? So it's mainly for HNI clients. Yeah, 50 lakhs is the ticket size.
Right.
This 50 lakhs can be in form of a check or your existing portfolio as well. So clients can transfer us the existing portfolio, and then we can of course realign the portfolios. I think that's one of the largest difference. Another one major thing. I think there was a misnomer somewhere, maybe in early 2015 or something. Yeah? PMS is better than a mutual fund, or a mutual fund is. I think both the products are equal. Yeah? And I think, as I mentioned earlier, it is not a question of an or, it is an and. Yeah? But now, since I'm from PMS industry, of course, I have to talk good things about PMS. Yeah, so I think PMS tends to do maybe over a longer period of time because it is more aligned towards investors' goals and everything, because the portfolios can be customized, curated, especially at Phillipcapital. That is what we do. We customize and curate the portfolios for each investor. I think that it helps him to achieving his goals. Yeah. So that way it's a more focused, it's a very nimble kind of a product. Yeah. So I can be, say, suppose if in 2018, where we are not very comfortable with the valuations of the markets, we are 60-70% cash. So I can be 100% cash in PMS, 100% invested. Another very big, I think, advantage of a PMS is it's very transparent. Though some people feel that it's not. I think in mutual fund, what happens, it's an NAV based product. Okay. But in PMS, it's a portfolio approach. So you get exactly when you invested, what is the current valuation, what are the fees, what is your current holding, what price we have bought it for you. Because for each investor, we are opening a separate demat account. So that is what happens. And of course, I think in PMS, there is an option of charging a performance fees as well. So what happens, client's interest and the fund manager interest is aligned. That we would also want that higher performance is generated, so our performance fees is also high. I think these are some of the large differences. Of course, then there are few other things as well. What happens in a PMS? It's since the assets are held in a client's individual demat account. Your money is not commingled with someone else. Something like what happens in mutual funds. For example, there is an ABC scheme, which is doing quite well. So suddenly from a 3-star, 4-star rated fund, it became a 5-star rated fund. So a lot of money comes into it. So suddenly from maybe a 500,000 crores AUM in that scheme, it went up to 5,000, 10,000 crores. Now the fund manager of that particular scheme will have to start kind of diluting his initial investment philosophy because so much of money has come. There's nothing wrong in the entire thing, but that is what he might have to do. Because earlier, say suppose he was not investing into any company wherein the promoter holding is maybe less than 40%, but there are only limited set of companies like that. So that is possible maybe at 1,000, 2,000 crores of AUM, but suddenly it has gone up. So he might have to start investing into companies where the promoter holding is less. So what happens, I've been an investor in that scheme since a very long time, but because of a lot of influx of new investors, I might see that the fund performance is not that great. In fact, what one of our studies says, once a fund attains a 5-star rating, mutual fund, there are very high chances that it will underperform.
It's just going down from there.
Another example, say suppose there's a small cap mutual fund scheme. Markets are going down and a lot of investors get panicky. I am a long-term investor. I don't want to exit. But because of a lot of exit redemption requests, the fund manager will have to start liquidating stock. Now in a bad market, what happens? Good stocks are the only ones wherein there is liquidity. Because bad. So what the fund manager, to meet the redemption, he'll start liquidating a lot of those good stocks. Now I'm a long-term investor. I want to stay invested into that scheme. I know because small caps, mid caps keep on going through different cycles. So that is again something that needs to be pondered about. Unlike in PMS, because it investment at the client level, if there's a redemption or anything, we immediately exit from that particular investor. So
Right.
all other investors do not get impacted, especially
Yeah.
since it's a customized portfolio.
Right.
Again, I think the bottom disclaimer is it's not that PMS is better or
Yeah,
mutual fund
yeah.
is better. I think both of them have their advantages and disadvantages. Yeah?
Right.
But this is what I would like to sum up.
Yeah, and also I think it also essentially the bottom line is how much risk-taking appetite do you
Yes,
have
agree.
is the decision-making factor कि आप किस पे कितना allocate करो
Agree.
या फिर mutual fund में ही रहो या वहाँ
Yeah.
पर you wanna go,
Yeah.
right? And so essentially what you're saying is PMS has a lot more agency and control over your portfolio.
Nimbleness. I would
Nimbleness,
not say.
okay.
I think
okay.
it's much more nimble.
Yeah, got it.
Yeah.
For the mutual fund, yeah.
So I'd like to use two words which have been bandied about a lot. Mutual funds are technically secular and democratic. The guy who's invested first and the guy who's investing at 10,000 have the same access to the same portfolio, which may not be the case because PMS investors tend to shift and right might be the case. But again, having said that, as he said very importantly, it's an and proposition. It's not an or proposition. Mutual funds tend to be a collective investment, and it's the best for any first-time investor. And I think, especially as far as the Indian domestic markets are concerned, they have been the driving force. They have been driving force for the fact that the IPOs also, which came in later, have been predominantly driven by mutual fund houses.
funds.
Yeah, and they have. As I said, it's someone who has just started earning. It's someone who's just a simple person who's doing blue collar jobs can also start doing and start earning from those, take benefit of the Indian economy's movement. We also feel that as far as we at Phillipcapital are concerned, we also do a lot of portfolio diversification. You may not get access to a gold and silver directly into a PMS or any kind of structured product, but then in mutual funds you can directly take it via a mutual fund or an ETF. So when we try to create a portfolio for the client, we look at all those factors. We look at mutual funds which have an issue when it becomes a relatively large size, mutual funds which are up and coming, mutual funds which essentially kind of are relatively unknown, and we try to bring them to the forefront. So yes, there at some point there was an issue with respect to size as well, but over the last 3-4 years people have started to realize that even with large sizes they're able to manage returns which have been decent or in line with the index which is there. Right, people who have stuck on to their investments. So essentially most investments in mutual funds come in the form of systematic investment plans, which essentially you pulls the money directly from your bank account into the scheme. That actually helps you bring in patience from your end as well as persistency. In terms of how the return is then built over a period of time. So whenever an investor comes to us here at Phillip, we tell them give them generally two options. One is you invest via SIP. So if you have a long-term horizon of let's say 10-15 years and you want to look at mid and small, you do an SIP for 10 and 15 years, your average returns will be very well. Even with increasing sizes, they are able to manage a relatively decent size of return. Best part about us distributor is even if there's a size issue, sometimes mutual fund comes us and tells us we can look at these schemes as well. So they have a scheme 2 or 3 which is like a semi-clone of the first one where there is no problem with AUMs as well. So we as distributors help you kind of navigate that shift as well. The other option is you could park the money into liquid and slowly transfer it into equity, looking at the timing of the market. We call it systematic transfer plan, or we can also look at to do it manually. So there are ways and means by which you can tackle market volatility. Mutual fund as a concept is a much more broader base in terms of because it may not be as nimble, but it may actually give you a sense that you are with the flow of the market. You're not missing out on the flow. So today, if a certain stock has moved up from let's say 5%, everyone in the portfolio is getting benefited in the same way. So each one is treated the same. The true principle of democracy. So so most mutual fund distributors like us are predominantly in the process of how do we manage the average return of the book. So if your goal is let's say 10 years down the line you want to get a house, 15 years down the line you want to get your children educated or so on and so forth. So we target your investments based on your goals. So and best part that we do here at Phillip is we try to handhold you in emotional distress, and when you feel that the market is not doing well and someone tells me that FD return has kind of beaten me. So that's what the main principle of what distributors or any kind of financial products is, that we are able to emotionally handhold you. More so in an Indian market where everything is so densely
I think mutual fund that way are very
Right.
excellent product for an entry level, and even for HNI clients
Yeah.
it makes a lot of sense.
A lot of sense.
So
yeah.
what we, in fact, in our PMS also, instead of because we customize the portfolio, so we can do stocks, we can do ETFs, we do even direct mutual fund plans as well. Yeah. So I always keep saying mutual fund sahi hai, par kaun sa? Yeah.
Yeah.
Because today what they have more than 3,000
3,000,
schemes.
yeah.
Yeah. Well, in fact more. Yeah. So it is. We have a universe of around close to around 4,000, 5,000 stocks, and maybe around close to around 4,000 schemes as well on the
Yeah.
mutual fund. Yeah. So it is which scheme that you are investing into mutual fund also becomes quite imperative. Yeah. Because what, as per our study, the best performing fund and the worst performing fund, the returns divergence is huge.
Huge.
Yes. So what we try to do under customized PMS strategy, where we invest into mutual funds, we not only study the back dated returns,
right.
but we study the portfolio, we study the investment philosophy of that fund, and then we try to choose the right kind of schemes as well.
Yeah.
So PMS, because I think the way it is more like my kids Lego, so you can do multiple things. So it
things,
is not only stocks. So PMS
Yes.
is not, especially at Phillipcapital, it is not only about stocks.
Yeah.
So we do multi-asset strategy,
Yeah.
wherein we make a mix of equity, mutual funds, ETFs, REITs, InvITs, precious metal through gold and silver ETFs. So we can do each of these things. Fixed income. I think fixed income is another very big subject. Yeah. Today in India, everyone has to say something about cricket and stock markets. Fixed income is something which no one understands, especially below AAA. I think that no one understands.
No one understands that,
So I think that is where we come into play. Of course, there are certain debt mutual fund schemes kind of things as well. But in our PMS, we invest into curated portfolio of bonds, or maybe we can do a multi-asset as well. So I think that is what maybe we can do a lot of mix and matches in on the PMS side, depending upon what the investor wants at the initial phases.
Yeah, so essentially you're talking that there are some fundamental structural differences between the two, and it sounds like PMS has a lot more flexibility. So yeah, let's just touch upon that. What are the structural fundamental differences between the two?
So if you have to look at, you are basically, when you enter a mutual fund, you are a part of an investment which let's say another 1,000 investors are doing the same thing. But mutual funds give you one very big thing: you are able to exit your fund within 2 days, irrespective of, except certain categories, you are able to exit within 2 days.
2 days.
Yeah, and we also have a fixed income portfolio as well. We used, technically mutual funds were the cornerstone of the fixed income market for a very long period of time, till certain events happened which kind of moved it to more private players right now. Also now we are now becoming custodian of metals markets as well. A lot of the metals money for gold and silver has technically moved into mutual fund, right? So your mutual fund is a pass-through product. Tomorrow, if there is a valuation to put art also, you can actually have an art-based ETF as well. So it is a pass-through. You can create a mutual fund out of everything. We may not be an experienced market like the US, but we have enough categories right now which each investor can look into it. So you are able to exit. It's an easy exit. The best part about it is taxation. You're technically charged as a whole. It's 20% and 12.5%, 20% short term, 12.5% long term, and that's, you have a more consistency. You are aware of what is happening. It's very transparent. Every month on the 15th, you get the portfolio disclosures. You are able to track it and on multiple platforms right now. And technologically also, since the best part about Indian mutual fund industry is that वो लोग एक स्टेज पे आके आपके all the CEOs and CIOs will talk about mutual fund as a whole. They may be competing at all, but they all got together and created more technological advances. So as far as the industry is concerned, we have made significant strides in terms of applications, in terms of portfolio reviewing. So that's what we do here at Phillipcapital as well. Going ahead, I think majorly that we would like to see is, it may not be super customizable, but your best part about it is if you have access to a distributor, he's aware of the process flow, what happens at a mutual fund, and if he feels that there is an exit call which requires with some schemes returns, he will be able to help you take that as well.
Perfect.
Yes, of course. See, structure-wise, we have discussed that,
and you've explained a lot.
So
how
I think,
structurally it's
so
different.
of course, again, I think, see, at the end of the day, it is about returns. Investors. I think return-wise, both of them are on par. Of course, there would always be difference between the best performing and the worst performing kind of a thing. So return wise, I think both of them are little bit here or there. So it is not much of a difference. It is actually investing journey is maybe a retail investor first starts with maybe mutual funds, as is wealth grows, then he also looks at maybe PMS. Going ahead, he might
Yeah.
look at AIF. Maybe going ahead, if his wealth increases, then he might look at PE fund. I think
Yeah.
that is what the journey is kind
Yeah,
of a thing.
yeah,
So that way, structure wise, I think there are large differences between.
Yeah.
In fact, SEBI's definition of a PMS is that it should not partake the character of a mutual fund.
Okay.
Yeah?
Oh.
So that is what it is. Yeah? So that way, it is much more customizable and all those things. But as I said, that it's about returns. Yeah?
Yep,
Client पूछेगा भाई
Client
बना
को
मेरा
तो वही चाहिए.
yeah, see if I make 15% returns
Yeah.
out here, 15% returns out here. So it is about diversification.
Right.
So it is not only diversification across asset classes, it is about diversification within the separate different products as well.
Finance
Different
products as
styles.
well.
Yeah.
And how do you guys like optimize for in times of volatility as a mutual fund? How do you optimize for performance for your funds, and how do you
So
do that?
when this happens initially at the beginning, that when you're creating the portfolio, you account, assuming you're investing, let's say an SIP of 10,000.
Yeah.
So we give you 3 or 4 SIPs, one which will be a little bit more conservative and which rides market waves relatively well. One which will be a little bit aggressive, which will take on the characteristics of when the market goes up, it will significantly go up. If you're able to do a lot of combinations technically in terms of that, we can also age wise also we can fluctuate. So if there is someone who's a 60-70-year-old person who's coming to us for investment, we can make the portfolio suitable to them where he will be able to achieve his FD plus kind of return. Essentially what we look at is from perspective that each investor needs to have one consistent base which will be around 30% of his portfolio. 30% of portfolio can be the one which does better than the market, and 30% which technically does much better than the market. So we try to
Higher
create
alpha.
higher alpha. Yeah. So essentially what we do is we create this structure for most investors. Someone who, unless someone comes to us with a very different ask, but that is all so what happens in the times of volatility, those consistent funds will take over. So technically your emotional response would not be so significant where there has been a significant loss in terms of the overall portfolio. And we always try to diversify multiple schemes. With each AMC has its own, each mutual fund has its own characteristics. Some may be chasing the market, some may be actually looking to create a new market for themselves. So we try to create a basket which features everything into it.
Got it.
I think the
PMS.
best way to beat volatility is time. Yeah. So we ask all our investors, please invest only if you have 5 to 7 years kind of an investment
Very fair
horizon.
point,
Yeah?
yeah.
Because I think once you are that is locked in, I
Yeah.
think volatility will because markets will always go up
and down,
I think
yeah.
but if your investment horizon is 5+ years, I
Yes.
think that a lot of that can
Yes.
be taken care of. Yeah.
100%.
See, there is no way. Yeah. Anyone can predict. Even the best of the best can predict.
And
what
if
is
they're
the
predicting, they're just lying or
Yeah,
trying
of
to
course.
manipulate.
Yeah.
If you could predict, we would be sitting at home.
Yeah, for sure.
Yeah. So there's no way to predict the bottoms and the highs.
Yes.
Yeah. So what I think time is the best healer, as they say
Yes.
within the relationship. I think even in investing, that is the best kind of a thing. Yeah.
Yeah.
So that is what we always keep asking for our investors. Of course, at our level, what we do, of course, we have disciplines in place. That in a single stock we do not go more than 10%. In
Yes.
a single sector we do not go more than a
Right,
certain percentage. I
right.
think those are the disciplines. Of course, we also do take cash calls, and because in PMS
Yes.
that's the
Yeah.
flexibility as well.
You
As I
guys have.
mentioned, in 2018, there was a time in my mid and small cap strategy on the PMS side, we are almost 50-60% cash. Right? So if we feel that the valuations are absurd,
Yes.
and if we feel there is more of a downside,
Yeah.
especially for a new investor coming in,
Yeah.
we are okay. Maybe
To just hold the cash
Yeah,
and not
yeah,
deploy
yeah,
the
of
fund.
course, yeah.
Whereas on the other side, if it is a mutual fund
Yeah.
and the fund is getting a lot of inflows, they
Yeah.
can't hold more than
No, so-
25% cash.
No, they are allowed to hold. There are certain riders to it.
Yeah.
If you're of a certain size and above, you're not allowed to hold, because technically, if you're a 1 lakh crore one lot size, if you have 10% in cash, it's a relatively significant
Yeah,
amount. So what they generally do is they try to put it into a liquid fund. It
Okay.
essentially gives
Oh,
a
yeah, fair,
6.5% kind of return.
Fair
So
point,
the money
yeah.
is still deployed and
Oh,
you're earning
in
something. on it.
PMS also, of course, the cash does not as idle. It's
Just-
also
you're getting
some
deployed
return,
into
yeah.
something.
Right.
Yeah?
It's at least beating inflation.
Yeah, but see, those
somehow.
kind of calls are very few and far
Yeah.
between. I think it is made the way we invest into stocks, the kind of selection of the stocks that are there. I think that makes a lot of difference.
So if any investor starts their journey, so say suppose 2 investors start their journey with the same amount of capital, one approaches just the mutual fund, one approaches the PMS, how would their investing journey unfold and what would their experience be?
So I'd like to just take what has actually happened. If you had technically started from, let's say, 2015, where the mutual fund, 2013, 2015 onwards, where the mutual fund industry kind of took a new form with the regulations changing in. Those investors who started from 2015 onwards would have had a very smooth sail, even if you have started with a small amount there and continued investing till now. They would have a decent return, which is much higher than the rest of the market, because you have technically in the fund for more than 11 years at that point of time. And someone who's just started just before the pandemic began or just during the pandemic, they would have the best ride so far because they would have taken the entire uplift. So if you're just starting right now, if or started from, let's say, 2024 also, I would tell you just stay put. As he said, time heals, but also the idea is that we need to keep telling him that no, you have to be there. The idea is to spend a longer time in the market to kind of get better returns. Also, if depending again on your age and your goals, we try to customize it for you, what kind of investment you actually need to do. So if someone comes to me, we need to understand that you cannot ask a 70-80-year-old person to do a small cap. You need to treat him accordingly.
More principal safety.
Yeah, and also not necessarily that everybody would like to do equity also. We would also suggest to him fixed income as well to kind of balance their portfolio. Right now, if you're going to ask me what to invest, I would look at multi-asset as a whole, which the mutual fund itself monitors between equity, debt, and the metals and REITs and commodities of that nature. And if a young investor is investing for the first time and he has a longer horizon in mind, let's go for mid and small. This is the best time to invest because there is enough valuation drop which has happened.
So of course, coming back to your question, if one investor invests into both the products at the same time, I think the journey would be similar. I think that there's again, let's take an example. Assume that both the places it's a decently managed fund by a fund manager of repute. I think the journey is going to be same. It's not going to be, as I mentioned earlier, it is not mutual funds. The returns are going to be much higher, or maybe PMS, which was a misnomer earlier, it is going to be much higher. I think the journey that way is going to be much
relatively
I think, but what happens, since mutual funds are very diversified portfolios, in a scheme there would be maybe 70-80 stocks. In fact, in most of the schemes, some of the flexi cap schemes, it would be more than 100 stocks. So volatility wise, it would be lesser, because as far as PMS is, maybe it's volatility wise it's little bit higher, but that's why maybe an alpha generation capacity of a PMS would be also slightly higher.
And speaking, you've like multiple times come out with this, that time is very important, is very important. And no matter how many times you guys, everyone keeps hammering it, people just don't want to digest that. They still want to bet their money, jo ne 2 saal mein hi chahiye ho sakta hai. And that is essentially where they will beat PMS or beat mutual funds. They will have to book losses when the market goes down because they were expecting some short-term return. So essentially, this should be a very baseline rule for anyone to be investing in equity. Whatever the route they take is, if you're investing it for more than 5 years, then only deploy those funds that you do not need for at least 5 years, right?
I think expectation management is more important, that this is the kind, see, over a longer horizon, let's take an example of last 10 years, 20 years, maybe 30 years as well. What Nifty or maybe Sensex has generated is around 12 to 13% returns. So this, what you basically try to do is your maybe inflation, 2x of inflation is what your return should be. So on an average, inflation in India is 5 to 6%. So if you do 12-13%, I think that is what overall, but because of a big bull market, so suppose which had happened in 2006 to 2008, maybe which happened from 2020 to 24, your expectations of everyone goes up. That in a very short period of time, I can make 2x, 3x, 4x returns. I think that is not possible because averages will always catch up. So I think that is what we try to always keep telling our investors as well. And as you rightly mentioned, it is more about 5 years should be your minimum investment horizon if you are looking at equity.
So you're not making poor decisions, right?
So we have to also factor in the fact that in your life there will going to be a lot of up and downs. So you might require the money when you may have had a 5-year horizon in mind, but you require the money urgently. So all comes back down to the basic element of how you construct the portfolio for your customer, for your client. Essentially, you try to ensure that the best possible time he's doing better than the market. But yes, his life needs are going to change and you also need to adapt with them. So he may not have a requirement. Suddenly he's decided after 3 years that he's looking to buy a apartment, or they're looking to get married, or have their children needs an education and they require money from him. So best part about what we do as mutual fund distributors or as advisors is we usually get down with the client. We try to understand what his life requirements are going to go ahead, especially with requirements to what his larger scale expenses will be. Tell him to meet those expenses. You can always have some fund lying around as cash. You can always have some fund lying around for all your larger goals.
Yeah.
And then as you can build up again, as he said, averages are very important. Always be an SIP investor, so you're not pumping in a large amount of money at one go, right? And then kind of averaging will automatically catch up.
And during the phases of, volatility, like it's going high volatility phases or even crashes, what's the biggest mistake that you've seen mutual fund investors make? And also, we'll come to you, what's the biggest mistake that PMS investors are making?
So I'll give you the most recent crash that happened. I'm just going to ignore 2022 and the one which we had right now, because this crash has technically it's not a crash, it's been significant fall.
Right.
The biggest crash that we saw was the early months of COVID, February, March of 2020. The people who persisted through that wave, persisted through the time, kind of did very well. The people who are chickened out at the last moment, people looking at 2-3 months of underperformance, kind of actually suffered the most because they realized that they missed a golden opportunity. In fact, what we have realized over with our research is it's like a rubber band. The more you pull onto it, it's going to come back to normal, right? So essentially, it's what we have seen. The more crashes or any kind of corrections that will happen in the market, the reverse movement is going to happen much stronger.
Right.
And as we've seen, the amount of demat accounts, number of investors who are putting in money into the markets have also tripled. There is there is a lot of demand, but there is very less supply. So automatically demand will try to create its own price. Right. So the rules of engagement with respect to the pricing strategy was very different 10 years ago or even 5 years ago, and which is what right now. Most mutual funds and PMS people who run PMSs have kind of tried to keep up with that, because the expectations are going to change in each market, which very often people say history repeats itself. But I would like to say in a sense that each time is different. You need to adapt as and how you keep going along, because we never realized what is going to happen after last 1.5 years, which has happened after the new elections came into play, both ours as well as the one which happened in the US. So we need to keep up with the times. Your portfolio needs to reflect what is happening in the market. You cannot technically be a person who does catch up afterwards. Right.
But most people are those people who are always just catching up when gold has run like 40-50% up. Everyone's flocking in, silver does that.
Panic, I think greed and fear.
Greed and fear,
coming back, So there's always a FOMO.
Yeah.
That 2 years back, everyone wanted to get into mid and small caps.
True.
Today, everyone wants to get into gold and silver. I think, coming back to your question, I think the worst mistakes that investors make is getting very panicky. What has been seen that if you buy, say suppose a good stock or a good scheme, even at a wrong time, then also you're still better off. You might not make excellent returns, but you still might make decent returns. But if you exit at the wrong time by panicking, I think then that is never possible. That catch up is never possible. So I think that is what we need. Keep telling our investors as well. That it's not the time. In fact, during COVID, 2020, there were many guys who were markets are going to shut down. There is all of us are going to die. This is not. We are asking for money. I think. Okay, this is a good time to invest rather than kind of.
But nobody was giving you money.
No, but fortunately for us, during COVID, in fact, in our PMS history, during COVID, we did not even have a single redemption.
Oh,
in fact, a lot of clients
that's so good. That's so good on your part of keeping them psychologically safe.
So it was a lot of, at Phillipcapital, of course, we have very high touch. Be it any businesses, especially in PMS wherein the ticket sizes are higher. I think, see, in a mutual fund, when you invest, if you don't know who the fund manager is, who you have not met, it's still fine. But in a PMS, because its ticket size is 50 lakhs, on an average, our client size is 1.2 CR. So that way, we are very much in contact with our investors, telling them, no, we have seen this kind of falls. Of course, COVID was something which came
unforeseen, black swan event.
It was, no one knew. But we are very sure that this is a transient kind of a thing. Of course, at that time we did not know that we would have a V-shaped recovery.
It was insane.
So of course, so we thought that over long term it might catch up, but this was a V-shaped recovery. It was so fast.
I think nobody could have anticipated that. Be the top hedge fund managers, PMS.
Single month in March, I still remember, Nifty was down 38%. Because of our prudent practices, our portfolio was down only around 16 to 17%.
Oh, that's so good.
But April, May, shot up like anything. Yeah. So I think, but again, I think what investors, the biggest folly of investors
Yeah.
is FOMO.
FOMO, yeah.
Yeah.
Either getting in at
Yeah.
something at the wrong time or
Yeah.
selling in something at the
Right.
wrong time.
It's just they feel safe in the herd probably.
Yeah.
It's always the mediocre decisions कि सब लोग अगर sell कर रहे हैं तो
Yeah.
I think it must be the right thing to do. सब लोग अगर buy कर रहे हैं it must be the right thing to do, and it
Yeah.
almost is always
And I think
reverse.
another one thing is what they compare one particular stock or
Yeah.
an asset class to an entire portfolio.
Right.
Yeah. So I keep getting at an issue. The returns are only 18-20%. Yeah. I bought this one stock and it has gone up 2x. Or maybe silver has done so well.
Yeah.
But then I asked them, okay, how much did you allocate to this one stock? Okay. He says I bought worth 50,000, 1 lakh.
Yeah.
So that 1 lakh has maybe become 2 lakh, but it is
Yeah.
not going to move the
Right.
needle much. Yeah?
Right.
So I think that comparison of one single stock or a asset class to an entire portfolio, that is also something. Yeah? So
Yeah.
what people don't understand is the power of compounding. If you
Yes,
compound your money at 15%, 18%
Yeah.
over 8, 10, 15 years, I think it's a very big number that we are talking
Yeah.
about. Yeah? But they are 15% क्या है? कुछ-
Yeah. Seemingly वो बहुत छोटा लग रहा है. The
Yeah.
compounding effect like takes
Yeah.
off like so
Most
good.
businesses are not able to make 15%.
Yeah,
So
true,
it's something
true.
which, so that's why we are unfortunately shifting towards realizing that in equity markets do well for us than our own business. So we have that entire philosophy has kind of started to seep in. So yeah.
True. Because most, in fact, retail or consumer businesses have 7 to 10% margins.
Yeah.
But by doing nothing, you
Yeah.
could just make 12, 15%
15%,
returns. Is some mindset also. Speaking of a lot of investors that you keep speaking with, do you guys see a lot of Gen Z investors
I see.
coming into
Yeah.
the investment
Same,
space?
yeah.
Is there some general behavioral change that you guys are witnessing from the previous investors of the Gen Z investors?
So when we came into the workforce in early 2014-15 was the job markets were relatively not so good.
Yeah.
We were still kind of picking up from where it left off after the crash in 2008. The current Gen Z generation is blessed that they have relatively good, decent job market. They have good opportunities. The scope has expanded because of the digital economy. They have much more aware. The information asymmetry which was there,
Yeah, it was.
with our generation has kind of not been there in this generation. But yes, with this also comes in the factor that, nay, I want to do this. There is no thought process which goes into doing selections.
Yeah.
We have seen people literally lining up on with cafeterias for couple of hours altogether, right? So it's the same thing with investment also. The bandwagon effect which was there earlier, that parents' generation and our generation has kind of taken a much more evil form in this generation.
Okay.
Like because my friend is doing, he's earned this much money. It was earlier with crypto and we kind of stopped that with the regulations coming in. It is now moved over to other asset classes. The problem with most Gen Z investors is that एक बार entry तो कर लेंगे, but then they kind of realize that it's a patience game. It becomes difficult for them. So for us as distributors or people who advise on mutual funds, it's our habit to handhold them.
Yeah.
It's like, no, you have started earning. You need to build up a corpus. You need to get into the frame of mind that patience and persistence are key to the game, right? We need to to reach a certain level of income, what you have taken. So ideas, we tell them, you materialize your goals. What do you want to do 10 years down the line, 5 years down the line, not in terms of a career, in terms of where you want to see yourself, in terms of how much money you are earning. So prepare for that stage. Assuming you are, now we have these new concepts which are coming in is dink and fire. So we also take into that consideration as well. What you are going to look at 10 year, 15 year down the line. Yeah, you're not going to be set. You're a new investor. You're just 3-4 years into the workforce. But you keep your mind open that you need to keep saving as you go along. You don't want to end up a phase 40 when you are 40 years of age, you don't literally have no savings and you've just blown it on next iPhone or the next cafeteria that you want to go in Bandra. So that's what I always tell them if I do meet. Whenever we do conduct sessions, avoid the bandwagon effect, have patience and persistence, and try not to mingle, try not to compare your life journey with someone else's, because everyone's going to be literally different.
Nishit, you have something?
I have a different opinion kind of thing. I think today's generation, the whatever you call them, Gen Z or Gen Alpha.
Gen Alpha though, I think are too young.
Too young.
But see, it is always कि I used to, my father used to, मेरे ज़माने में ऐसा होता है. I tell her,
yeah.
I
मेरे
feel,
हमारे ज़माने
yeah,
में
this,
भी.
our generation is better. I
Yeah.
think what today's generation, I think they have a lot of much more information.
Yeah,
I think they are
true.
much more smarter.
Yeah,
They
for
know
sure.
what they are doing. Of course, everyone makes a mistake, and I think that is not an issue. Yeah. See, in PMS, of course, we do not get a lot of this new guys because
Yeah, because
the
they don't
tickets
have that much.
But what we have seen, a lot of parents, then they entrust their kids. Okay, why don't you look at this?
Yeah.
Yeah? So what we all, they come with a certain kind set of a mindset, yeah, that wealth is going to get created through stock markets.
Yeah.
So we tell them that no, wealth is always generated through your businesses
Yeah.
and through your salary incomes.
Right.
Yeah?
Active income.
Yeah.
Correct.
Why you invest is because you want to first diversify,
Yeah.
from your business. You do not
Right.
want to keep all your eggs in
Yes,
one
yes,
basket.
yes.
Second thing is why you invest into stock market is because you want to beat inflation.
Yeah.
See, for inflation for us is not maybe 2, 3, 4, 5% what government publishes.
Right,
Yeah.
right,
For
right.
a lot of us, the inflation is maybe 10%, 12%
true,
as
true,
well. Yeah. Why? Because earlier maybe I used to have a coffee. नीचे वो टपरी पे बैठता था. His cost has maybe grown from last 5 years from 5 rupees to 10 rupees, so
Yeah.
which is 6-7%
Yeah.
inflation. But today I also have a Starbucks coffee.
Yeah.
Yeah. So my inflation is much higher.
Right.
Yeah. So to beat that inflation, that is why you invest into equity
Right,
markets. Yeah. Of course, wealth can get generated.
Yeah.
But you need to be patient.
Right.
Yeah. It cannot be short term. So this is what we tell the new set of investors who have been maybe managing the family money.
Yeah.
So that they come with our नहीं यार 3 साल में a lot of wealth can be generated into stock markets. I do not need to maybe focus on my dad's father's business or something like
Yeah,
that, and
yeah,
they
yeah,
start looking do this kind of a thing. So I think that is what. But otherwise, I feel that the Gen Z, I think they are much more smarter.
Yeah.
There's so much of information.
Same, likewise.
Yeah,
I
yeah.
think the same.
Yeah,
They're
so-
quite smart. The older generation are quite worried about them.
Yeah.
That they're kind of reckless.
Yeah.
They're impulsive. But they have a lot more information
Yeah.
as well. They're quite smart. Yeah.
And see, we are in that in between generation.
Yeah.
Yeah.
So wherein we have seen days when there was no mobile phone, and today there's so
Yeah.
much of information
Right.
as well. So I think that way I don't see much of a difference.
Yeah. What's the one thing? Because a lot of Gen Z investors are not coming to the PMS, but I'd like to put this question for you. What do you think is the best move in terms of their financial journey that Gen Z is making that maybe previous generations were not doing? And then what's the worst
I
mistake
think
they're
one
doing?
big advantage which Gen Z has because of the information overload that they do have
Yeah.
from the internet and from social media is that they realize that there is a need to save
Yeah.
to achieve certain goals or achieve whatever they are looking to achieve in the long term in their lives.
Sagar, it is not the need to save; it is the need to invest.
Yeah.
See, I think need to save. We Indians,
Yeah,
we
true,
generally
true.
had that from
Yeah.
our parents' time.
This
as well.
generation is not saving as
so
much.
I think what I see, because we look at a lot of this other industries as well, and especially we invest into asset management companies, the wealth management companies. A lot of these guys, what they get their salaries. Of course, now opening for the account is quite simple.
Yeah.
So they open their accounts, they do those SIPs immediately,
Yeah.
and of course they spend a lot of money as well. I think investing is one of the biggest, that even how small it is, and that is why we have seen explosion of so many demat accounts, so much inflow coming into mutual funds and everything. So I think that is one of the good things about
The best part. Like they're investing quite early also. They have the information access also. And I think investing in equity, the risk for most people has always been uncertainty. कि हमें पता ही नहीं है, हमें तो लगता है शायद zero पे ही ना चले जाए. But these guys come armed with a lot of information, historical data, stats, and they've kind of reduced their uncertainty कि how this is going to move,
True.
and that makes them,
And
quite
the
well
risk
equipped with the
taking
investment journey.
appetite is also maybe
Also,
higher. So
yeah.
suppose when I started, my first thing was अरे PPF में डालना है,
Yeah,
okay, or maybe
right.
FDs में करना है, maybe tax saving
NPS,
ELS.
CSR, yeah.
There maybe risk taking happen. Okay, let's do a mutual fund SIP.
Yeah. Yeah.
Yes,
No, no, essentially the
No,
fact
very
that
well in
yeah,
India.
the
Right.
fact that they are able to think of this is because the generations have kind of provided for them.
Yeah.
We are much better off than our parents' generation. They are much better off than our
For
generation
sure.
because the people who came before have provided for them.
right.
That's why they're able to take a call like this. But
Right.
yes, coming back to my original point, the idea is to save. It can be in the form of investment and just to keep money aside for whatever you require. it is now mostly a prerogative that also most Gen Z also feed off each other.
Yeah.
I am doing this, you should also
Yeah,
be
true,
doing
true,
this,
true.
right? It's more like initially you come in at this is a trend, like people would like to invest, we would like to save, and then it becomes should then generally become a habit, which
Yeah.
we have a very limited period time with Gen Z right now, but
Yeah.
I hopefully it should become a habit, that it becomes, because for us the habit for saving and habit for investing came about little later when we started actually building up decent incomes, but I think it's coming very early for them. It's become easier to invest, just open up an app and you can put the
Yeah,
money inside.
that also.
Yeah, and now the
Just clicks
yeah,
away.
yeah. So fintech has technically helped bridge up a lot of the information asymmetry. But yes, end of the day, the call is yours. How you
Yeah.
intend to take it, it's up to you.
Right.
How certain people can only handhold you to a certain generation. But yes, what I actually found with this generation is that they are very independent with their thinking. It also, they really need to be guided, because
Yeah.
what has happened is the thing which we also lost from our previous generation is that the initial generation used to give us a lot of guidance.
Yeah.
And it's kind of gone down with
Yeah, yeah,
this
yeah.
thing. So to become investors and to stay long invested, you need to have patience, and
Yeah.
that can one way is to obviously learn through experiential learning. You suffer something bad and then you learn. One is you listen to your people who have been there before and learn from
Yeah,
them.
yeah.
Yeah. So I think as we go along, most Gen Z investors, when they see the entire market playing out with a couple of cycles at least in,
Yeah.
they'll kind of become more aware.
Yeah,
By
for
the time
sure.
there'll be another generation to uproot them as
Right,
well. So
right, right. So speaking about the information that they're consuming, that the source of that information, you've seen a lot of information being put across through social media.
Yeah.
People are learning from YouTube, self-educating themselves, then coming into stock markets, investing mutual funds, whatever it is. Do you think it's reliable? How's it helping them, and maybe how's it also like harming them?
So most of the investors look at a couple of videos which are circulating maybe from their favorite influencer
Yeah.
or favorite people who are peddling classes or online classes, and
Yeah,
they
yeah,
come
yeah.
about doing it. You sometimes they may not be in your best interest, because at the end of the day they're looking to sell something.
Yeah.
I'm not going to say no, because we are, end of the day, we all into a service business.
Right.
But then your independent thought should be my idea is always to train Gen Z to have
Yeah.
independence of thought. To a
Right.
certain extent, they're able to identify what is right, what is wrong.
Right.
You have to understand from a completely 360 perspective.
Yeah.
How much the taxes implication is going to be, how much you're actually going to be spending,
Yeah.
how much is going to be the next trip that you do. Yes, unfortunately, what has happened right now is that a lot of these people are taking in going on spending larger amounts using EMIs. That technically needs to stop.
Yeah.
That only happens with a relative amount of guidance.
Right.
And you need to open up to the fact that you require guidance. I think one thing which has been very good with this generation, they're able to take help for mental requirements.
Yeah.
This can also be for financial requirements
Yeah,
as well.
yeah.
That also needs to be drilled in as we go along. That you do require help. It
Yeah.
cannot happen on your own.
Right.
As you are providing a service to somebody, someone else is providing a service to you.
Yeah.
You cannot also be dependent on what you learn from social media or from your friends. You need to take an independent thought in terms of finally what you actually require and what you are going to doing to achieve those requirements.
Yeah, fair point.
Yeah, no, see, again, I think what they are good and bad about everything.
Yeah.
So, social media does provide a lot of information why one needs to invest and all those things. But because I think their risk taking appetite is higher, they also get into the wrong set of products. Yes,
Yeah.
suppose derivatives. Yes,
Yeah.
so of course, new generation has taken a lot into SIPs, but they also taken into derivatives.
100%.
Yes? And in fact, the
And
exchange
cryptocurrency.
data
Yeah.
itself shows that
Crypto and
96%
derivatives
of the
like through the
traders
roof.
lose money.
Yeah.
So maybe they think, अरे यार 50,000 loss है ना,
Quick,
risk लेने में क्या
right,
होता है?
right,
Yeah?
right. They think this is their chance to take a big shot,
Yeah.
either just lose this much or like.
Yeah. So I think coming to a specific query, I think of course there are good things, but because they get influenced by the social media, maybe
Yeah.
by the network effect or anything, yeah, I think they also take higher risk, and
Yeah.
that's why they lose higher money as well.
right,
yeah? And I see a lot of those guys. Yeah? So
Yeah.
suppose because we have invested into a couple of NBFCs, so guy who new generation guy who goes, he will not ask what is the price of the iPhone. He'll ask what is the EMI.
EMI, which
Yeah?
is so
Yeah,
bad,
yeah,
which is
much
like
worse.
so.
Yeah, so but that is again, I think
Yeah.
that is
We were
the way
expensing a debt cycle where
Right.
the
Solid,
requirement
yeah.
it's like how the pre Gen Z America came
Yeah,
and millennials
yeah.
for our generation.
True, the
they went
credit
into a
card
debt cycle.
generation,
Yeah.
buy
But
now,
I
pay
think that
later
is how
stuff.
each of the
Economies have come,
Economies,
yeah.
have evolved,
yeah,
and I
right.
think we are also going through that.
Through that,
And that
yeah.
is why there is a lot of demand.
Consumerism is like
yeah.
very prevalent.
Yeah.
So
Yeah.
I don't
Yeah.
think there's something wrong, but as
Yeah.
Sagar said, that if there is a proper kind of someone to coach them around,
Yeah.
or maybe give the right set of advice,
Hmm.
they're also very receptive. I
Right,
think let's
right.
not demonize.
100% yes.
I think that's
Yeah.
the very. It's
No, we have
not-
had a very
I
short
think-
period with them. We'll have maybe
Yeah.
10 years, we'll get an answer.
Yeah.
No, but I think that our parents also thinking the same
Same
thing.
way.
"Arey yaar,
नहीं,
कुछ
वो-
सुनता नहीं है."
Yeah,
Yeah.
that's a tradition that we pass on. We never believe in the next generation.
But that is
Yeah,
how
true.
it is. Yeah, like,
Yeah.
it has to be
True.
that.
Correct,
It
correct.
has to evolve. Yeah, it can't be the same. Yeah.
So I think I am a lot more closer to the Gen Z generation, and then I also
I am
consume a
also.
lot.
I'm not that old. Huh?
Yeah. No, so I'm a Gen Z, the most senior Gen Z kinda. So I consume a lot of information online. I see a lot of people. I think what the point that you said was very apt. Like you should not be outsourcing your thinking to an authority.
Correct.
That's what Gen Zs are like very good at. They won't listen to their parents or the
But you technically listen to
They'll
your
like
influencer.
cross check it, whether or not you're saying is right or
Yeah,
not.
yeah.
They should also be doing this around investments, around whatever financial education they're seeking, whether or not what they're consuming is reliable and things around that also. So they do not have, so they can also figure out who to rely on, who they can trust, but always cross checking and thinking for themselves. Right, and so that's how they can consume slightly better. But the good thing about the Indian market is a lot of good firms like you guys, like a lot more firms, they're coming up with very high quality information and education for the average consumer, for the average retail investor to learn, and they have a lot of credibility. So that's also very empowering for the current generation and consuming this data.
Yeah. The idea is that we need to be there, as I said, emotionally available to them.
Yeah.
You rely on your mental coach. You also rely on your financial coach to take you to bad times.
So, speaking of money investing, the end goal of money kinda is what? And at what point does it make it enough for them to like feel ki, okay, money's problem is like sorted? Yeah.
Money is a vicious cycle. The more you have,
Yeah.
the more you want. So it's again comes down to you as an individual. Every individual has a separate. Nahi, I'm content with this level of money in my life. There will be some people. No, I want more. So idea behind it is that we need to be open to all of that as distributors or advisors of products. That there will be people who will always want more. There will be people who are satisfied with a certain level. Nothing. This is again depends on how you have been brought up in terms of what your upbringing is in that sense, and what your thought process is as you have grown as an adult, and also people who have been there around for a long period of time who are a little older than us. It all comes down to very simple things. Money is what you make out of it.
Yeah.
You can have the most amount of money and not be happy. You can have the
Yeah.
least amount of money and be happy. So there is no end goal, but to achieve certain goals, money is always there.
Yeah.
Yeah, that's very philosophical. See, again, I think the new generation, I think they are very short term in nature.
Yeah.
That way, yeah, they would say that okay, I want to do so many trips, I want to maybe buy this and
Yeah.
that. I think for them it is that. I think over larger clients who have made sufficient money, I think for them it is how they are able to maintain this and grow it at a decent pace. Yeah. So it is for them it is not about generating a lot of new wealth.
Yeah.
It is then taking forward this kind of a thing, legacy,
Yeah.
and maintaining it, and then generating maybe inflation plus kind of a return. Yeah. So there is, of course, there is never too less or too
Too much of
more
money,
thing
yeah.
to more, when it comes to money, especially in a country like India
Yeah.
where there is such a large dichotomy. You go down and you feel that there are people who are not getting sufficient food, and then
Yeah.
there is, of course, a lot of wastage that happens at the other end. But I think what I think that way money, what is the is maybe wherein you can give enough good amount of education, maybe you can do a few trips here or there. I think that is what should be sufficient, and that is what I've seen a lot of HNI clients that we deal with, they are fine with that.
Got it. And so, what do you think is a risk that a lot of investors think that they understand, but they actually don't?
I think when it comes to risk, yeah, what they understand is that maybe I am not able to make enough money, or
Yeah.
maybe I need to generate maybe inflation plus returns.
Yeah.
But when they overall see their overall portfolio or
Yeah.
maybe overall wealth, say today a lot of guys they invest into FD.
Yeah.
The returns post taxes maybe what suboptimal
Yeah.
5.5% at max.
Yeah.
If you're in the highest tax bracket, it is less than 5%.
Yes.
So they understand safety, because safety karna hai, but what they're losing out is, in fact, it is inflation is eating into your money.
Yeah.
Because inflation is going at 6, 7, 8%, and your money is going at only at 4, 5% kind of a thing. So they understand safety as
Yeah.
a aspect, but they are kind of ignoring
Right.
the returns.
Yeah.
So I think that is one thing. So
Very well said, yeah.
So again, when I talk to investors, they'll say, "Oh, this stock has done so well.
Yeah.
And this one company I bought, it went up by 3x." But I look at his overall portfolio.
Yeah.
It has underperformed big time.
Yeah.
So they again, so it is about a lot of mix when it comes to this particular.
Right.
Yeah, so most of the time, the risk which people miss out on is that they are, especially from the older generation, is that they were so used to a certain type of investing because the options were limited. As and how the options keep increasing, so will the difficulty in terms of actually addressing those. Because today, early generation had 2 or 3 products. Now we are close to 50 to 60 products, which are very varied across. The risk which they do is, especially for do-it-yourself investors, is that they try to do it themselves.
Yeah.
It is not your forte. It is basically you're essentially going in to do a certain activity. You're cooking, but you don't know how to cook. You're looking at referring certain books and certain manuals, and you're cooking. Instead of that, I always suggestion is always take somebody along with you for the ride. They will be there to guide you. Yes, you can always move around the guide as well, but it's one of the major things which they underestimate is that they require a guide to help them out on the financial side as well.
Yeah.
That is what they kind of brush it under the carpet. No, I don't want to. I want to save on a minuscule amount of money, but I'll ensure that. But end of the time, it kind of backfires on most of them.
Right.
Yeah.
Like at least
It is
emotionally
about, it is about
backfired.
specialists in every
Yeah.
So
Correct.
suppose if I am getting my house done, rather than running behind a carpenter or maybe the contractor, I will appoint an
agency.
architect. Of course, there is a fee attached to it.
Yeah.
So similarly, as when it comes to financial products, it is more about you pay a fee, small fee, but then you get
Get
the
the
right
expertise.
direction.
This is what
Yeah.
you can like. Just always tell to doctors this. You can always go. I can always go to WebMD. Would you advise me to go to a WebMD and check out my symptoms and put it onto it? It's like that. So it's financial advice is like that because they're able to understand what you are essentially feeling with respect to your money. You are able to understand how your potential path is going to get mapped onto.
Yeah.
So they kind of help you in terms of getting yourself aligned to what you are intending to do.
Right. Very fair points, like the DIY investor. You talked about that some guy was talking that he's made like 3x returns on a stock, but then you look at the overall portfolio, it's ideally underperformed the index fund, which would have taken like zero stress and just gotten him 12-13% returns. So at what point does the stress of managing your own money, the emotional expense that you're bearing, become too much for them to be managing their own money?
I think that I've seen a lot many successful DIY investors as well.
Right.
So it is not that one cannot manage his own wealth on his own. I think they're very, very good investors. I've seen in my career kind of thing have done very well. But I think most of the guys were very busy with their work. Okay, they cannot give a lot of time and energy. See, because it is no longer about 30-40 years back, like a Parsi investor, you buy your Tata shares and you keep it below your pillow and you can sleep now. Because it's changing so fast. So I think if you are a person who is very busy kind of thing with your work and you have not been able to give enough time, and if you procrastinize a lot kind of thing, for them I think this is either a mutual fund or a PMS or an AIF is the right kind of a vehicle for some to give it to someone else to manage.
100%. I think that's such a valid point that a lot of DIY investors can like sail through by themselves really well. I think it comes down to essentially these two factors. A, whether or not you are genuinely interested in the business world in general. You like studying economics, you like studying finance, and then you also have the time to do that. If both the things are well done, you could really be a very good investor by yourself and like probably make a lot more returns than any other source.
If you're consistent and
Yeah.
disciplined,
Yeah.
in any field,
Right.
it is not only about finance.
Yeah.
If you're consistent and disciplined, then it is fine.
Yeah.
But what we have seen, most of the investors are, they might be okay, no, I will manage it,
Yeah.
but then they are not disciplined and it
Okay.
is not consistent in nature. Yeah, so then they lose out, kind of a thing. They might buy the right stock,
Yeah.
but if they don't exit it after 2-3 years at a good valuation, then it is back to square one.
Yeah. Right. So you have something to add, Sagar, to this?
No, I think what has happened, especially right now, is because the information symmetry has gone down significantly, and the ability to invest via multiple host of services has gone up. We have reached a certain place where everything is available to you.
Yeah.
Like you have an entire buffet, you need to know where to start,
Yeah.
and you need to select the right items in
Correct,
the buffet.
correct,
Otherwise, you'll just
correct.
fill yourself
Yeah.
up. Yeah.
Speaking of which, the DIY investors approach investing in a way, in their own ways. How would a PMS or a MF fund manager approach that differently to a DIY investor? Like,
Right. So when any kind of structured investment, can be an MF or a PMS, they have a wealth of research and lot of thought process which has gone into building up a certain kind of style
Yeah.
goes into it. So he has tested it, he has seen how it goes across market cycles, he has tracked the returns, he has tracked market, he has tracked the volatility which is prevalent in the market at that point of time,
Yeah.
those particular stocks or those particular fixed income bonds which have come into play. So when you are investing via a structured medium, they are aware of what you require. They actually get down and come down to brass tacks and look at what aspects are you looking to consider when you are investing, right? They also try to meet your expectations and try to set certain expectations. So they do both the activities simultaneously. Yeah, this is the expectation you can set, and these are the expectations that you have, and we'll try to translate those into returns. So that's where a structured advisor, mutual fund or a PMS come into play, where they're able to kind of meet that balance between both these activities and help both these activities happen at the same time. You understand what the expectation, and you set the right expectation, and most importantly set a timeline, because timeline is very important. Also keeping the fact that as mutual fund investors, you need to understand that there is a lot of flows and ebbs which are going to happen in your life, so you have to keep yourself abreast to that as well.
Yeah.
And we always tell them, be open about what your problems are facing. We'll be able to guide you through a certain phase in your life as well.
So, what we're trying to understand from here is what's something that a DIY investor just can't do that you guys can actually.
I think in today's world, there's nothing that you
Yeah,
can't do or
right.
something. I think, see, I always say there are 1,000 ways to make money in
Right.
stock market as well. Yeah, it is not that this is good or this is bad. What we have to work is that this is our style, kind of a thing. And we are putting in a lot of efforts. See, today managing someone's 50 lakhs, which is the minimum ticket size, it's a very big money.
Yeah.
It's someone's hard-earned money over last so many years. Yeah. So what we try to, of course, we cannot guarantee or assure any returns, but what we try to do from our side, that the research efforts that we put. Yeah. So we don't do any kind of trading or speculation activity. We are pure long-term investors. Yeah. So what we try to do, whichever company that we are investing into does not go kaput. Yeah. And we try to invest into companies where the EPS growth rate is going to be at least 12 to 15%. Yeah. So if your EPS is going to be 12 to 15%, automatically maybe over the next 2 to 3 years, your returns are also going to be that much. Yeah. 12 to 15. P multiple will also expand.
Right.
Yeah. So your returns will also expand. Yeah. So I would say that for us, it's a full-time activity.
Right.
Yeah. And we are answerable to someone.
Yeah.
So that's why we are more prudent. Okay. A DIY investor can maybe take higher risk because he does not need to answer someone. But again, I think it is not information edge is no longer there.
Right.
When I started my career,
getting
a Phillipcapital report was so difficult. Yeah, I had to keep requesting my friends who are working here, please send it to me, and he would send it to me maybe after a month or something. Today, a Phillipcapital report, or maybe even some of the larger companies, the report gets released and it's available immediately on WhatsApp and on social media. So I think that edge information, but what is important today, it is voice and noise.
Right.
Because there's so much of noise right now, you have to distinguish between, and that is maybe because it's a full-time effort for us. We have a very large research team out there at Phillipcapital as well. We are maybe able to do that in a more prudent way.
Justify it. It's something.
And what is the biggest mistake that investors in general who are like underperforming even the index fund, these basic DIY investors, these guys are making, that is like not even helping them to stay above that.
So I have a very simple answer for that.
Yeah.
If you are underperforming the index, generally, if you are underperforming the index, we try to how you have come into that stage. We will look into it.
Yeah.
So most of the times when you underperform the index, you have not invested as an SIP or as a continuous sort of investment. You have put it at one shot and then you have maybe underperformed. That itself, the first step itself is wrong. So we always tell them, even if you're putting, let's say 10,000 rupees, you divide it across 10 installments and put the money. So you can get the average of 10 market periods. Now, assuming you have done the mistake and put the money in, we tell you to stay put, because at some point they will correct. The whole purpose of a mutual fund, active mutual fund, is the KRA of the fund manager is to ensure that he beats it. At some point he is going to beat it at some level. So one option is, if you've already made the mistake, stay put, you're going to come back to normal. And if you're investing via an SIP, you will most of the times do better than the entire market. This changes when you look at mid and small cap, because it also determines at what point of time you have come here to invest. At most of the times they tend to even out after 3-4 years of being in there. And if you have continuously stayed as a SIP investor, you will see yourself outperforming the market at most times. Maybe it may not be high. So if the market is giving negative 6%, which it did over the last year, in small cap you may be 3%. If you're doing maybe mid cap, you are minus 2% or 2%, you are at another 4-5%. So you will still be higher than the market, and the investor needs to know that someone has put in the effort to ensure that he's doing better than the market.
I think, see, all of us go through underperformance. In the last 18 years of my career, I have underperformed for many months as well. And best of the fund managers go through the underperformance. It is, no one can always ever beat the benchmark. In fact, you know about this famous bet between Warren Buffett, kind of thing, wherein the benchmarks did well. So I think that is always going to be there. So, but in my experience, of course, you study why the underperformance is. Say, suppose over the last 15 months, lot of fund managers are underperforming.
Like everyone's portfolio has ideally underperformed.
So you try to kind of analyze why you are underperforming. Have you made any large mistakes?
Some fundamental mistakes.
Or maybe it is because of the market structure. If it is because of the market structure, kind of no. Then it is the time to in fact get more confident. There are many companies in our portfolio wherein in fact we are more comfortable at this valuation. This gives me more comfort. So maybe then I think the mistake a lot of maybe DIY investors or maybe investors do make is they tend to change their investment strategy. So what they would do, this has not done well, so let me change. But if you have analyzed it, and if you have not made any mistakes and you are just trying to capture what is trending right now, I think if you change, then you'll try to catch a running train and you might fall down. So I think the mistake is that if you tend to change, of course you always have to evolve. I cannot say this is my only circle of competence. I need to increase my circle of competence. But if you keep on changing as per the market kind of a thing, I think that is where you might make a mistake.
And I think exactly doing that, the biggest loss that you're going to make is you're going to lose your judgment quality. सबसे important तो है आपको अपने ऊपर भरोसा होना ही बंद हो जाएगा. Whatever decisions I'm making, I think I should have done that. Oh shit, I should not have done that. And ideally, the more decisions you make, the more chances of you making the bad ones, and then you'll just corrupt your judgment.
See, suppose 2022 onwards, defense PSU did
very well.
Now, a guy who had not invested into it, he felt, no, I should change. And he would have gotten into that bandwagon on 2024. Now they have corrected 25-30%. So you sold off your maybe banking stocks or maybe consumption stocks to get there, and this is the place which has corrected, and in fact this space has gone up. So now again you might, nahi, abhi gold or silver अच्छा चल रहा है. So let me get
तो यहाँ से निकल गया. And then you're always investing around the peak. And that's where
difference between trading and investment mentality.
Exactly.
If you're a trader, you're going to move between segments irrespective of the loss. So the idea is to be an investor at all points of the market.
It's way better. Like it puts all the points very well aligned. Stock markets is not where you create a lot of wealth. You just come here to beat inflation, maybe park your additional money that you won't have to use, but real money has to come from there. But when people come here to generate wealth, they'll do all the corrupted decision making, make short-term bets, do the trading, and just eventually 96% people then end up losing their money. Yeah. And speaking of this, what is something that you want to convey to the investors, to the average retail investor?
So I'll just, as I said, been saying, patience is the key.
Yeah.
Being in the market is more important than timing the market. Be an investor. Don't be a trader. Don't try to be just trace trends. It's like how trends change in certain things. Trends change in markets also. You are there for the long run. Behave like you're in the long run. In times of turmoil, in times of high volatility, have a level mind.
Yeah.
Always say that this too shall pass.
Right.
Yeah. And if you are not able to do it, we are there to do it.
Yes.
I think what I would say is save, invest, and diversify your portfolio.
Yeah.
And have a long vision. I think this is simple. See, sometimes investment is not rocket science. We try to, of course, we all experts also try to put in a lot of jargons and everything. I think that way it's very simple. You have to invest maximum, okay? You have to diversify, and then you have to have a long-term vision, and you have to keep on analyzing. So suppose even if you have invested into mutual funds or a PMS, keep on analyzing. Is the fund doing well? It's not doing well. If it's not doing well, what's the reason?
Right.
Okay, if it's not doing well, but the portfolio companies are doing well, it's maybe time to invest more rather than maybe withdraw.
Reduce,
Kind of. I think that is more important kind of thing. So it's very simple. Kind of a thing.
I think it's simple. It's just not easy for a lot of people, but it's quite simple. I think if something is not working for you, you just don't say, "Oh, there's just losses. It's just why is it bleeding? What's the structural problem? Is it something that has happened before? Was it overvalued that it has corrected? Did you invest at the wrong time? Understand and try to figure out why you're investing. Was the decision right? Why it did not work out? Then correct, learn, and then eventually you will be a lot more.
Otherwise,
seasoned
what
investor.
happens is people make wrong decisions.
Yeah.
So suppose so many guys have invested into derivatives, they lose big money. Then they feel, अरे यार ये stock market में तो कभी invest करना ही नहीं चाहिए.
Exactly.
And then they close their door for maybe 3-4 years. And then again they will come at the peak.
Again, when the FOMO is like peaked out, like I've been wrong for so long, maybe I am wrong, and then they again enter at the wrong time.
I've heard this many times. Many अरे सट्टा बाजार है, इसमें तो कभी invest ही नहीं करना है. But I think because of
they played satta.
No, they
played
got into
satta.
the wrong. Because we have seen so many boom and bust cycles. There are so
right.
many investors who lost their hard-earned money during the previous scams and all those things.
In fact, every bull run traps a lot of those investors.
So, but what if you are level-minded? If you have diversified across the various asset classes as well, I think you would have done well.
Right. In fact, they don't just close doors for themselves. Sometimes they close doors for generations. Not their.
No one is allowed.
No one in the family is allowed. Like they put a very hard stop there.
And they're very proud. Like, no one from my family invests into.
True. So thank you so much for joining this episode, Sagar and Nishit. It was lovely to get all the insights. I hope the viewers got a lot to take away, learn about investing. And so Sagar from Phillipcapital handles mutual funds, and you guys can definitely try and get in touch with these folks. We'll enter all the information there. Nishit from the PMS, anyone who's a high net worth individual or your dads are, do connect with Phillipcapital and try your hands and explore. We'll see you in the next episode of Capitalise. Until then, signing off, Pathanjan. Bye-bye.